Welcome back from lunch. I hope you had a great brain date session. It sounded like there was some really nice, interesting discussions going on. So welcome back to the afternoon. And our next panel is a panel full of regulators from around the world, which is really interesting because this clearly has a potential to shape FinTech. And it's quite an interesting topic for you guys. So what I'd like to do actually is give them a chance to introduce themselves and tell us all a little bit about what they're doing in FinTech in their location and with their mandate. We'll start there, and then we'll have some questions. Welcome, gentlemen. So David, why don't you go first?
No problem. Well, good afternoon. My name's David Gill. I'm Director of Policy at the UK Financial Conduct Authority. Broadly, what that means is I'm responsible for all policy that we produce. And as part of that, we deliberately cited our innovation hub within my area. So our innovation hub does a number of things that I'll come on to in a moment, but it really should be helping to drive and shape our policy as we actually look to future-proof what we do. I think so first thing I was going to say, when we look at the title of the panel in terms of sort of how is regulation helping to shape FinTech, I think the first thing I was going to do was actually reverse the question, because I'm not sure that regulation should actually shape FinTech to a large degree, okay. But I'm equally not sure that FinTech should shape regulation to a large degree. I think there's a balance of something in the middle. And actually what we need to do is adapt, and we need to move forward, and we need to, as I say, future-proof what we do. What do I mean by that? Well, I think in the first instance what we see is quite a lot of positive innovation. So positive innovation should be allowed to flourish. I think we'd all agree with that in this room. I'm sure from a regulator's perspective it's something that we all look at. What do I mean by positive innovation? Well, innovation that benefits consumers is certainly how we look at it. If I look at our innovation hub and the criteria for the support that we will provide, I look at our Sandbox in particular, the criteria that we apply for coming into that is that there must be a genuine consumer benefit. So something that flows through to the end of consumers to make their lives better in some way. That could be it makes things easier, could be it makes things quicker, could be helps to inform them better, so it actually improves transparency. It could be it improves access for people who might be excluded. There's a whole range of potential benefits, and as regulators what we don't want to do is stifle that. We want to encourage that and help to build competition in the market. As the FCA, we have a competition objective. One of the indicators of a healthy competitive market is positive innovation. Is firms doing things to actually push other firms and actually move the market on. So positive innovation, I would say, is a good thing, and regulation needs to keep up with it. Now, one example of this, actually, where we've seen this is actually development of the cloud. So perhaps not that new now, but actually firms were coming to us and saying, we want to use the cloud. We think it's cheaper for us to use as a storage method. It's easier. In many cases, it's more secure than what we have at the moment, but your rules don't allow for it. Well, actually, when we take a step back and we look at it, we could see that there were examples where actually it was cheaper, it was easier, it was more secure than what firms were using at that time. So why would we want to get in the way of that? We didn't need to change any rules, but we did actually produce some guidance that gave firms confidence to actually start using the cloud. So that's the sort of thing where I think actually we can work together with firms and we can focus on positive innovation. If I take the other side of the coin, though, not all innovation is positive. We certainly see some things that are actually a little bit scary when you look at the retail market, and things that retail consumers shouldn't be necessarily getting involved in. And actually what FinTech does in some cases there is makes it much, much easier for people to lose money or make poor decisions in things that they struggle to understand much, much more quickly, and on a repeat basis much, much more quickly. And that's where regulation does very much have a role to step in and make sure that actually people are treated fairly. And that comes back to some of the sessions right at the beginning of the day when we were looking at, or I think it's the first panel sessions were talking about regulation and the role it played with fairness, but also people's biases. So if we see something that plays on people's biases in a negative way, that's where I think we as regulators have a role to step in and say, no, we need to design rules to actually stop that, or we need to supervise our existing rules. I think I would also reflect that actually for the most part, a lot of what we do, we haven't needed to change many rules. Most of the rules we have are actually reasonably future-proof now. But actually what firms struggle with is how do I fit within that when actually the rule wasn't designed with what I want to do in mind. So that leads me onto our innovation hub. So what are we doing and why are we doing it? So if we go back 3 years, firstly we took on our competition mandate. So we have an objective to promote competition in the interests of consumers. We also have a duty So we have an overall objective to make markets work well, then 3 sub-objectives, one around consumer protection, one around market integrity, and one around promoting competition. And we have a further duty that if we take any action to further any of our other objectives, that we must do so in a way that is the most pro-competitive. So this actually helps to drive the work that we're doing on innovation, but it's not the be-all and end-all of it. Around that time, we also went out and we talked to firms and we said, we're actually quite surprised that we're not seeing more innovation in some of these markets, particularly among existing firms. What's the blockage? And one of the things we found was that firms saying, actually, we really want to do this, or we really want to do that, but we don't understand how your regulation applies, and that's stopping us. Now, in some cases, actually doing this was a really bad idea, and they really shouldn't be doing it. In other cases, actually, it was a really good idea, and we were sitting there thinking, why not? And so part of the genesis of our innovation hub was to say, as regulators, maybe we needed to move on and actually have different conversations with firms where we might explore the why not question as opposed to the, well, it doesn't fit, so move on. So we set up the hub to do precisely that. And our first offering, if you like, through the Innovation Hub was our direct support. So we have a small direct support team that basically just works with firms who come to us with questions. We have a set of criteria for them coming in. So again, it must be something that if it's already right across the market, then no, we're not going to help with that. That's not what the purpose of it's for. If it's something that's new, yes, we're interested. Is it basically just going to make the firm more money, or is it basically something that we can see flowing through into consumer benefit? There's consumer benefit. We're interested, and we will help. And the firm needs to have done a bit of work for itself. We're not a free consultancy. So we looked to them to have done their own research and thought about it themselves in terms of how regulation applies. So there needs to be a genuine problem, if you like. Since we set that up, we've seen around 800 firms actually come to us with questions. In around half of those cases, actually, we've been able to say things like, you don't need to be regulated, not for us. You don't need to worry about us in this particular instance. Others, we found that actually it's already existing in the market, so we can point them to that. But around half of those firms have had questions that actually we've engaged with on a regular basis, and we've had some really good conversations off the back that have really helped those firms to move forward. And perhaps unusually for a regulator, the satisfaction rates of those conversations are sort of in the 80%. So even those firms that we've actually said, no, you don't need to work with us, that encompasses those as well. So that's a good thing. The second, and probably the sexiest, if you like, is the Sandbox. So the regulatory Sandbox was something we set up to help firms test ideas in the market. It's about people taking ideas that they think will genuinely, again, benefit consumers, but they don't really know whether it's going to work. They don't really know quite how it fits. And they might need something from us to enable them to go forward and test it. So again, that's one of the criteria we have there, is they must need something from us to do that. So we have a number of tools we can apply. We can give a firm a restricted authorization, so we can actually authorize them or give them permission to do something for a set period of time, for a set number of customers, or for set amounts, or whatever it may be. We can have a restricted authorization, which is quicker than going through the whole process, and they also have our support as they go through that. We can waive rules, where that's in our gift. We do write our own rules. We also have to comply with European legislation and government legislation. We can't waive those, but we can waive our own rules if appropriate. We can issue no enforcement action letters, which will broadly say, as long as you've done the right thing by your customers, if it goes wrong, we will not come after you from a regulatory perspective. And we can give individual guidance. Now, I think the first thing we thought was actually we would probably be waiving rules quite frequently. Actually, we're into the third cohort of Sandbox applications, and we haven't had to waive a single rule yet. What we have done is quite a lot of individual guidance and quite a lot of restricted authorization. So most of what firms want to do can be done under the existing framework. It's just about the how, not the what. RecTech is another big feature of what we do. So we have a RecTech team who works very closely with firms of all shapes and sizes, regulated and not. We'll get them together in sort of venues much smaller than this, but actually take some large firms, some startups, consultants, coders, you name it, we'll find them. And we'll set them some tasks. We lock the door, we buy them a pizza, and we don't let them out until they come up with some solutions. And actually, we see some really positive things come out of that. Firstly, I think the first big surprise, actually, was that the firms are prepared to talk to each other if you pick the right topic. So you can get around some of the aspects of working with my competitors if you pick the right topic. So we've picked things like access to financial services, making financial services work for people with mental health issues, and things like interfacing with the regulators, so actually regulatory reporting, and can we take some of the friction out of that using things like artificial intelligence and so on. So that's been another really positive thing. And we also work with regulators across the globe. We look to learn from each other. We look to share what we see, both actually with the market itself. So we do report back on what we see in the Sandbox, for example, but also we work with other regulators and other jurisdictions. And I think the final thing I would mention is future policy. So we need to keep up with what's happening in the market. We need to be on top of our policy making. We need to make the right policies. We need to make them future-proof. We can't do that if we don't know what's going on in the market. So actually events like today, people going through the Sandbox, people coming through our direct support, are absolutely crucial for us in seeing what's happening and what's going on. So I would encourage anybody who's got good ideas to come and talk to us. In terms of what we've done with that, well, I've already mentioned the cloud. We've run a number of events, sort of focus events that we run ourselves. So we ran one on Robo Advice, where we actually encouraged the people to come and talk about potential propositions. We had some colleagues join us from the US, which was really helpful to actually say what was happening over here as well, because it's probably more happening over here than there was in the UK at that time. We've got a call for input out on distributed ledger technology. So actually thinking about what are the potential applications. We've seen quite a lot of potential, but actually where is this potential going to go? And what does that mean for our regulation? And that comes back to some of the things we talked about algorithms this morning that maybe we can get into in the questions. So broadly, we're very supportive of innovation. We've tried to do a number of things through our innovation hub to try and work with the industry. And I think that's the core theme for me, is I think it's something we need to work on together to make sure we get the balance of regulation right. I don't think it's particularly about fintech shaping regulation or regulation shaping fintech. Thank you.
Well, thank you, David. And I'm sorry to have arrived a bit late. Such the nature of the news these days, that it's somewhat unpredictable. But Ryan, do you want to pick up there and give the American perspective on whether you're creating a sandbox too?
The American perspective. That's a lofty responsibility. So good afternoon, everyone. My name is Ryan Van Grack. I work at the U.S. Securities and Exchange Commission, and I help oversee our FinTech working group. I'm glad to be here and have the opportunity to speak with all of you about the intersection of FinTech and regulation. But I want to begin with the requisite reminder that the views I express today are my own and don't necessarily represent the views of the commission or staff. I see we got,
If you'd care to expand on how
we've
you
got
might
cameras,
differ from some of your colleagues,
and
that would be
this is
great.
getting recorded, so I think we're all clear. If you could bold that, that'd be great. But innovations in FinTech, more seriously, have the potential to transform virtually every aspect of the securities industry, from streamlined market operations to more affordable ways to raise capital and advise clients. And those changes compel us to think carefully about how best to protect investors so that they and we can have comfort in these new products. And with that rapid change and innovation comes heightened responsibility on innovators and regulators alike. It is incumbent on entrepreneurs to be mindful of their role within a broader regulatory environment. A technologist wading into the finance industry is not just an innovator, but also potentially a market participant with important duties and obligations to investors. On the other hand, regulators must evaluate how existing rules address both the challenges and the opportunities presented by these new technologies. And we want to do so in a way that doesn't stifle beneficial and responsible innovation. Today, I'll just briefly touch on 3 FinTech developments that we are focused on at the SEC: distributed ledger technology, automated investment advice, and marketplace lending. In terms of DLT, which has the great potential to impact how the securities industry operates, promising new ways to place, clear, and settle trades, and novel means to facilitate capital formation, we are closely tracking and monitoring the technology and already addressing it in certain contexts. We have solicited comment, for example, on the utility of DLT in recent rule proposals related to transfer agents and the shortening of the standard settlement cycle. And we're also mindful of how it could impact capital formation. Our division of corporation finance continues to evaluate potential offerings of DLT-related financial instruments including the rise of initial coin offerings and other similar vehicles for raising capital using VLT. In July, for example, the Commission issued a 21A report about the applicability of the federal securities laws to this kind of new regime. In terms of the rise of automated investment platforms, or RoboAdvisors, in February, our staff issued guidance related to RoboAdvisors that highlighted these unique business models may raise certain considerations under the Advisors Act. And at the same time, earlier this year, our examination team launched an initiative focused on RoboAdvisors that will address their compliance programs, their advertising and marketing, portfolio management, data protection, and cybersecurity. A third area we are closely monitoring is the rise of online marketplace lending platforms. From the SEC's perspective, we're most interested in determining whether these platforms, including the securitizations of these loans, are made in compliance with the federal securities laws, including whether those offerings should be registered. As with other fintech developments, a core focus for us here is on investor protection, including the adequacy of the information received by investors in registered offerings. Now, taking one step back, as part of our focus on these and other fintech developments, we have enhanced our coordination both within the Commission and outside of it in order to ensure that we are approaching these issues deliberatively and comprehensively. And so, for example, last year we formed this FinTech working group that I referenced earlier, consisting of senior staff from across the agency to evaluate these emerging technologies. The group is focused on understanding the developments, engaging with the industry, and determining what, if anything, the SEC should do to provide clarity on existing regulatory requirements and help foster responsible innovation. In addition, last year we hosted our first ever FinTech Forum, which brought together entrepreneurs, thought leaders, and other market participants to discuss the most significant and pressing issues impacting the fintech industry. And our working group has made great progress under our new chairman, Jay Clayton. Earlier this summer, around the time that we launched our 21A, or issued our 21A report, we launched an email address, fintech@sec.gov, which is for anyone to reach out to us with fintech-related questions. We have a group of policy experts that quickly address and respond to these inquiries, and given that you all are here today, so have at least a slight interest in the fintech space, I would encourage any and all of you to reach out to us to the extent you have questions or issues they think would be appropriate to raise with a regulator, although I should say in the first instance, getting securities counsel is also a very good early idea. But I want to highlight that inbox and that idea because outreach and engagement is a very important component of what we're focused on, because it's critical that we hear from stakeholders because we want to make sure that we are striking the right balance, which I think David alluded to, and make sure that we're reaching the right results so that we can understand and best address these cutting-edge innovations.
Well, that's fascinating. I'm just curious, though, there's a difference in, before I turn to Jeffrey, the difference in sort of focus or tone between the SEC and the FCA. I mean, David's talking a lot about almost encouraging innovation, trying to create an environment, almost working with innovators to see, how bright ideas can float up. You're emphasizing more sort of investor protection, which in many ways is more the traditional role of a regulator. Do you see that difference in tone and focus, or is that just a journalist nitpicking?
Can I answer that honestly? Consumer protection is an equal objective for us with competition. What we think our approach to this is basically if we understand the innovation that's there, if we can work with the innovation as in its early stages, actually we can ensure that consumer protection is there. So the Sandbox is a classic example of this. In order to come into the Sandbox, we will ensure that the test is safe. So a firm that comes into the Sandbox, if they're testing something, we will make sure with that firm that if customers lose out as a result of the test, they will be put back in the position they were beforehand. If we can't get that assurance, then we don't take the test forward. So I don't think the two are mutually exclusive. I think actually we can work with innovators, but we obviously need to keep an eye on consumer protection. And the point is around actually shaping the regulations so that when that innovation comes through, it comes through in a way that is fair to customers. What we're definitely not doing is actually dialing down the levels of protection that we have. But it's about actually we think that actually you can deliver protection in some ways through competition, by fostering innovation. We don't encourage people to have the ideas. We encourage them to come to us when they've got the ideas.
Right. I mean, Ryan, do you see yourself as a champion of fintech?
Well, what I would say is...
Or does your boss see himself as a champion of fintech?
Right, exactly. Well, I think the way David frames it, I think it makes it we're much closer than I think either the question would suggest or other optics might suggest, in the sense that there's a balance here. As the primary regulator of the securities industry, we have an interest in encouraging innovation that benefits the market, investors, and capital formation. At the same time, we must remain vigilant in our mission to protect investors in the markets. And there's obviously an investor protection component there, but I also don't want to lose sight on whether it's the FinTech Forum or our inbox that I referenced. Those are important, efforts to engage and have outreach with the industry for us to learn and for innovators to learn and receive guidance as well. And that's a very, I think, important part of what we're doing, and a message that I hope is not lost. And part of the reason, I'm plugging the email address as best I can. This is about the fourth time in 5 minutes, is because that email again? Right, exactly.
We can flash it up if you want, yes.
We made it simple. Is because that is a very important part of what we're doing. And so in that regard, there is a balance that you're trying to reach, but I don't think there's necessarily an inherent tension that you have to choose one over the other.
Right. Well, I'll turn to Jeffrey now, because you're the person on the panel who is entirely free to speak their own mind. You used to work in the public sector, but now you're essentially liberated. So tell us what you really think about the process of regulation.
Thanks, Jillian. And I think it's first of all, thanks for having me here. I'm Jeff Banman. I'm a former regulator. I was at the CFTC in a variety of roles, both supervisory and looking into leading a staff working group looking at blockchain, and then I was responsible for developing the agency's fintech strategy for Chairman Giancarlo, which resulted in the launch of Lab CFTC, which was the CFTC's formal innovation hub in May. And I think, first of all, I think it's sort of an example of the wry sense of humor of our conference organizer, that she elected to put the regulators in charge of keeping everybody awake after lunch, which I think is always a challenging speaking slot, and I think it's a real tribute to my fellow panelists that I think this actually is a quite lively and important topic. I'd say that from the perspective of both, I can speak freely as a former regulator, but I think I'll start off by just kind of giving the regulatory perspective for the audience of kind of how we thought about it when I was at the CFTC, when we thought about, what should our footprint be in this space, and how did we go about figuring it out, and how did we look at it? And, people tend to think of regulators as sort of monolithic, and having unlimited authority and resources. In fact, that's very much not the case. So the starting point for all of us is, what is our statute? What is our authority? And David started out by talking about the FCA's mandate has to do with promoting competition. You do start out there, as a starting point. And it's very interesting in my experience at the CFTC as we started our outreach as part of Lab CFTC, and there were people who thought, well, the CFTC is good at regulating markets, so we've just started up this cryptocurrency marketplace. Would you come regulate that because you're good at overseeing markets? So would you come oversee ours? And as a regulator, you get to do what you're authorized to do, not just anything you think you would be good at. So at the CFTC, as we thought, what can we do that would really have an impact in this space? And we studied other programs, and we spoke to the SEC, we spoke to the FCA, and really great engagement and help from other regulators around the world. We discovered that everybody who had started a regulatory program, whether they called it a sandbox or some other name, like an accelerator, a launch pad, a facilitation, there are all sorts of names. My boss liked the name Lab, so we were Lab CFTC. That was, we had a name even before we had quite fully defined what was going to be in it. And what we found looking around the world was that, there were a number of programs that made it easier for innovators to engage with the regulator, to sort of take that fear factor away, to promote faster legal certainty. We found a lot of innovators frankly felt that when they were talking to the regulator, there were two problems. One of them was that they just could never get an answer. And when you're a startup and you're trying to move fast, any answer is better than no answer. Even if they say, no, you can't do that, they say, well, what if we did this? That's better than things just languishing and people just running out of kind of energy and funding and whatnot. So that was very important. A second thing, frankly, was one-stop shopping. So something as simple as this email that Ryan is talking about. What was that email again? Yes, or at the FCA where there's almost like a case officer to support that. So it's not like you call a phone number and you're starting over with everybody. We talked to firms that have been through these programs and learned what some of those benefits were. So one objective was to make it easier for innovators to engage with government. The second, and this was a very important part of the CFTC program, was something that we called CFTC 2.0, which was how could the regulator itself use some of these innovative new technologies to learn these technologies to itself become more efficient and effective as a regulator. That's very important. Those are very complementary objectives. Some of the recent work that David alluded to at the FCA, in terms of their RecTech work, they're doing things like automating their handbook. I mean, they're doing some really interesting things, and those are both, very important parts. And so I think, one thing to bear in mind is not only do the innovators benefit, but the regulators benefit. And if the regulators can regulate more efficiently, that benefits the markets. I guess to go to your last question, Jillian, how do we sort of, assess the effectiveness, and are these doing the job? I mean, certainly I think we're in the early days, and sometimes, it's what exactly are the metrics when you're doing something new? How do you measure the effectiveness of it? I think outreach is an important first step. I think that, you really do need to balance promoting innovation and engaging and learning about that with investor protection. And I think every regulator will always come back to, the innovation side, but also the investor protection side.
Right, thank you. Kathleen, do you want to add anything to this?
I just had a question actually for Ryan. You mentioned that one of the topics you're focused on is Robo Advice, and there was an argument kind of coming from industry that some Robo Advisors were almost like 40 Act funds, like mutual funds. What happens when it even extends now to like fractional shares that some companies are doing, which provide a really great low-level entry point for new investors, but pose all kinds of other risks? How are you guys thinking about that?
So I can't address that specific topic, but
Okay.
I think the one thing that I would highlight in this space is that in many respects, even though the vehicle is different in terms of a robo-advisor maybe not having any direct human-to-human interaction, the questions are still often fundamentally the same in terms of how are you building a compliance program, how are you meeting your Advisors Act requirements. The vehicle may be different, but in terms of how you're assessing the risk profile of the investor and how you're monitoring and taking custody of your assets. I mean, the technology may be different, but the questions are still the same. And I would urge anyone in the space to look at the staff guidance that we issued back in February, which posed a lot of these questions and didn't necessarily address some of the specifics you're raising. But I think the help there is it at least helps orient you in terms of how we are looking at the issue. And I think it raises a lot of good questions that I think anyone in the space would be well served to evaluate.
But just following on from that, I mean, the problem with a robot is you can't put it in prison. So how on earth are you going to actually create meaningful elements of liability or controls or anything like that going forward?
Do you want that? Well,
Or maybe you can put a robot in prison, have an AI robot that gets punished.
Yeah, well, so, I'm sort of visualizing that a bit. But, I think that, whether you're talking about, trading algorithms or robo-advisors or, algorithms that you use to make lending decisions if they're unfair, deceptive, or abusive practices or whatnot. So, I think that, there are there's an element where there are traditional frameworks, and technology and technology innovation is not new. I mean, I think we are in an unprecedented age where there's a convergence and acceleration of these technologies. But the thing is, with all of these new things from a regulator perspective, you have an algorithm that did something. How does it work? What factors did it consider? How does it weigh them? Have you got some sort of record-keeping capability so you can actually have a record of what was the state of the algorithm and what inputs did it decide in doing that? It's kind of accountability and an audit trail. So the notion that you can just say, well, the algorithm did it and I have no responsibility when I'm the sponsor and person running that business, I think that is one of the challenges both for regulators and for innovators who are leading these companies they need to start to solve those problems. I think it's something that we as a society expect. But if I may just go one step further, I think that does highlight an issue, which is historically, most regulation has focused on entities. You have registrants, broker dealers, clearing members, clearing houses, exchange. But more and more, technology is enabling these things, and in the bank ecosystem as well. It's activities, it's subsets of the activities that were formerly done by regulated entities. And I think it is pushing us into a paradigm where regulators have to look at, activity-based regulation rather, like what is the activity rather than who is doing it. And, it shouldn't matter whether it's, Amazon or Ant Financial or Alibaba. If somebody is doing that activity, there needs to be a mechanism for oversight and audit trail and accountability for these protections.
Right, because everyone's paid a lot of attention to the issue of driverless cars and who would have liability there, which of course is still a very uncertain area. But I think the debate about AI, automated processes, robo advisors is only just starting in the financial industry. Do any of you know of any tangible cases where liability has actually been awarded or decided in one of these cases with robo-advisors or some form of automated processes?
I'm not aware of any in the UK, but I would echo what my colleagues have said, basically, which is we have looked at this and we have set up an advice unit to work with firms who are looking at robo-advice solutions, particularly to help answer some of the questions about how do the existing rules apply. And what we've said is basically we focus our attention as we would now with a face-to-face advisor, and I think many of the issues are the same. If we look at assessing suitability of decisions that have been made by a face-to-face advisor, we would look at the inputs. So what are the questions they've asked? Have they asked the right questions? We would look at what they've done in terms of considering what's suitable and what they've presented to the client in terms of the information, for example. So we'd look at those things. If we take that to a robo solution, and if you find challenges in a robo solution, what do? You look at the inputs that have gone in. You look at what's been presented for the options in terms of that potential solution, and what does the customer understand about that, and what they're getting out at the end of it. So again, I think you can look at the outcomes, you can look at the inputs, and we would look to have someone responsible for that. So someone in the firm who is qualified, suitably qualified, needs to be responsible. And if someone is responsible, then you may not be able to put the robo in jail, and we may not put someone in jail. But actually, we would be able to take action against the firm and the individual if we found particular problems in those cases, the same as an individual advisor. Slightly gory, but there is one way of looking at this in terms of, we looked at this from the perspective of a face-to-face advisor. You don't try and see what's going on in their brain. You look at the same things we've just talked about, which is the questions, the outcomes, and so on. When we tested and worked with firms in the advice unit, we've looked at what is the testing they are doing to test their algorithms. Some of these things, for example, might be actually in the testing phase. They will go through the outcomes, they will go through a series of scenarios, and they will test that with qualified advisors. And you can actually do some testing to get to the point of giving yourself comfort as the firm. I think there are some ongoing questions actually around when the machine starts to learn and come up with its own decisions. But again, I think the same principles apply. You would expect someone within the firm to be responsible for the systems, the controls, and the processes that sit behind it.
Right. Well, any machine that can teach itself to play Go is going to be able to teach itself to give pension advice, and may not always be quite what people expected. But sorry, Jeffrey, I can see you.
Well, I was going to say that there have been cases not specifically robo-advising, but in algorithmic trading, where a recent case, where the CFTC learned through a whistleblower that, looking back at the flash crash of 2010, that in fact that there was a trader in the UK who, through great cooperation, has since been extradited, but had devised, he had modified some trading software to create a spoofing algorithm, which he used from a garage near Heathrow Airport to manipulate one of the largest futures contracts in the world by spoofing large buys and large sell bids and offers. And this was eventually detected through a whistleblower, and staff was able to track, do forensic analysis of, what the algorithm did and how it acted in the market, was able to, act in that case. Now, at the time, it took, years to detect it, and the initial analysis didn't uncover that. So I think, the regulators are kind of develop as they have new authority and need new tools to keep up with these things, because these will present new challenges. But there have been cases of accountability for these algorithms.
But you see, the issue, which I find fascinating, and then I will move on to onto the very exciting topic of Bitcoin. But before we do that, though, I mean, that case of the Heathrow trader was down to malicious tampering of the software. What fascinates me is what happens if one of these algorithms go mad and start giving advice, on the basis of not a malicious tampering, but simply a malfunction. Ryan.
You can tell I'm so eager to jump in there. Look, I mean, I guess I'd say two general things. First, certainly from the SEC's perspective, but I think many regulators, and maybe I think David was alluding to this as well, generally speaking, the focus is on regulating conduct as opposed to regulating technology in terms of whether there's kind of a bias in one direction or another. And I think we can come up with hypotheticals of technologies that don't quite exist yet, but you could foresee it, and everything ends up, or it's often facts and circumstances. But if you're an investment advisor, if you're a broker-dealer, you have existing obligations and duties when creating an algorithm or monitoring assets or providing advice. And so you don't necessarily abdicate responsibility because you have technology that's assisting you in the process. That's why no one has has brought charges against a terminator, but there have been cases that involved algorithmic or electronic trading, because at the end of the day, there are still core responsibilities and duties that weren't met or addressed because there is some sort of flaw or problem within the underlying technology.
I mean, one of the other questions I had, though, Jeffrey, which I'd like to ask all of you, and maybe Jeffrey can comment on in particular, is, so do you really think you have the skill set and expertise to track what's going on in the technology world? Because traditionally the SEC has been full of lawyers who know everything about markets and finance. The FCA has been full of people who know all about markets. Insofar as there's tech expert in the regulatory world, it's sat in different agencies. How confident are you that you actually have the expertise needed to keep track of what's happening out in the markets?
I mean, well, I think that is a priority that both former Chairman Massett and current Chairman Giancarlo of the CFTC have articulated. Now, these agencies are funded by Congress, and there's been asked for significantly greater technology resources to cope with exactly these types of challenges. And for example, I was responsible, in addition to working on the kind of fintech and blockchain things, running the division that oversees market infrastructure, in this case clearinghouses. And we had one of the biggest threats and risks is cybersecurity, and so we had some cybersecurity experts. We had our own kind of white hat hacker who was trying to keep up with kind of the latest developments. And our job is was not the regulator is not the one primarily responsible for the security of the infrastructure. The entities themselves in our regulatory framework is, but we need to understand it enough, or as a regulator, to supervise it. And frankly, one of the things that occurred was, as fast as the agency could hire and train these people, they then got hired out by the private sector. So even I think there's a lot of rewards and intellectual satisfaction of these government jobs, and the agency has been able to attract qualified staff, but as soon as they get up to speed, they get hired out. So I think it is hard to retain them, and I think I agree with the premise of your question that as these markets get even more technologically driven and complex, we will continue to need people with new skill sets, you may be able to retrain some of the existing staff, but I think you will need new skill sets and new tools.
What about the argument that one way to outrun all the Goldman bankers for you guys would be to actually automate certain functions within what you're doing, supervising, monitoring, tracking? Have you guys considered that?
So we can have Robo Regulators.
That's it.
Well, the one thing I could say, point to in that area is there are certain parts of the SEC that continue to find ways to harness big data and technology. And one area where we see that is on the examination side. We have hired, quantitative analysts and those who both know how to harness and interpret and utilize big data so that we have a more risk-based model and approach when it comes to our examinations, which means we're more effective and efficient at both kind of deciphering what are the issues that we should focus most closely on when engaging with a particular registrant, even deciding which registrants to examine in the first instance, and then we can process data far more effectively and efficiently. So what would have taken maybe weeks, months, or years can be done in a matter of minutes. And so maybe that's not full automation of everything. There aren't robots going on the exams, but that is a definite focus, and you see that across the commission. But I think the examination and also on the enforcement side that we've been able to put good use to that.
I mean, I would echo most of that. I think what we look to do is try and get as sophisticated as we can in our prioritization, and we do look at the use of things like big data as well. I don't think we can be complacent, I think at all. And actually, if you look at the issue of pension scams, for example, which aren't necessarily tech-driven, but actually it's spotting them in the first place that can be the biggest problem, particularly where they happen in the unregulated space. And a lot of the solutions that we're talking about may actually be in the unregulated space being used by regulated firms. And in some ways that's actually a benefit, in some ways that actually makes it harder for us to spot it. So I think that the challenge of finding it will always be there. I do think having a focus on outcomes rather than necessarily the process helps us with that, because if you look at the outcomes, you assess the outcomes, and you look for fairness across that piece, then you can find an indicator that something is going wrong. Do we need to have coding experts to then go into the algorithms and so on? I'm not sure we do, because we can actually buy that in when we need it, if right. That's the case. So I think it's about having a balance, but I do expect regulation will evolve as time goes on as right. well, as Jeff has said.
Yeah, and one thing also, so as part of the CFTC 2.0 program that I mentioned, we had keen interest in, could we start to experiment with some of these new technologies, somewhat the way that the Bank of England has a wonderful FinTech accelerator proof of concept program, and the FCA does something like that. And we discovered that, as a government agency, if we just wanted to test a new technology, procurement laws, there for the most, anti-corruption, transparency, good reasons, stood in the way, because, procurement works well when you want to buy a system and you are able to run an 18-month process. But if you just want to see whether the capabilities of something works or learn what they are, there may not even be, 3 providers, to provide one of these new technologies. The innovators may not have gone through all the aggravation to become a government contractor. And typically, like in industry, a new company may say, all right, we'll give you a below market rate for this software and you can go test it on your data and systems and analytics. As a government official, you're not allowed to accept what's considered a gift, something below fair market value. So in fact, some very basic common sense things that you think, well, gee, can't the regulators test out some of these new things? There are concrete obstacles that stand in the way of that, and like DARPA and the Defense Department can experiment with these things, but financial regulators in the U.S. I think are somewhat hamstrung by right. these regulations.
That's a very good point. Yeah. Before we turn to the audience for questions, I just wanted to quickly touch on the topic, which I know from looking at the Financial Times website arouses enormous passions. In fact, we call it a bit like the Kim Kardashian of the financial world, because every time we mention it, it gets readers' eyeballs suddenly attracted to that article. And that, of course, is Bitcoin, or ICOs. We have some interesting differences opening up in terms of different jurisdictions' approaches to this in terms of regulation. Can you explain why you've taken different approaches towards Bitcoin and ICOs? And do you expect those differences to remain, or do you think that there's going to be growing convergence between the UK and US style of regulation on Bitcoin and ICOs?
I think to start with, actually, most jurisdictions have slightly different legal basis in which they're set up. So if you look at, contrast the UK with some other areas, we have rulemaking power, we have a particular set of objectives and so on, and we have a particular remit as a regulator, whereas in other areas, the regulation looks quite different. So we regulate all conduct across the piece, whereas, of course, in the US, there are multiple agencies for different types of things. Again, I'm not sure it is quite so inconsistent. I mean, there are some inconsistencies in terms of, certainly in China, for example, actually going as far as a ban. In the UK, we've issued an alert. The challenge, I think, is that actually a large portion of the ICO business can actually be outside of our regulatory remit. And therefore, what we've done is taken an approach to say, this is not necessarily inherently evil. There are some advantages to it and so on. It's, in many cases, you need to look at, what, as a consumer, what are you getting yourself into? So actually, what are the protections that exist? Is this in a regulated space? Is it in an unregulated space? What's the information you're being given? Do you understand the potential to lose money? Do you understand the potential of the speed at which you might potentially lose money? So we've tended to focus on that approach because, firstly, we think that's proportionate to the issues at the moment, and secondly, because we do have this issue that it may be within our gift to do something where we find particular problems, but it may actually be outside of our gift if it's in the unregulated area.
Would you prefer to ban it?
We have taken an approach of issuing a consumer alert because that's what we feel is proportionate at the moment.
Right. What about you, Ryan? Would you like to ban ICOs?
Well, we haven't. In July, as I mentioned earlier, we issued a 21A report on the topic, and I think it had many components to it, but I think at least two important takeaways were, number one, we wanted to make clear that using virtual currency or distributed ledger technology does not remove a transaction from the purview of the federal securities laws. And then I think the second part is that each offering needs to be evaluated based on the facts and circumstances. So it's not so much about banning one thing or another, but rather there is existing law about whether or not something is a security, and if it's a security, it's going to fall under the purview of the federal securities laws. And in our report, we laid out kind of our thoughts on and provided essentially some guidance on how we go about kind of conducting that inquiry, and the hope was that would help those who are in this space better understand and think through various issues as they either invest in or decide to utilize this, relatively new means of raising capital. And I think in terms of the different approaches that you're seeing, it's also fairly early days. Our report was issued in July, and I think since then, it's only been 4 or 5 months.
Well, since then the price has gone crazy. I mean, it's gone,
Right. But in terms of the number of regulators that have spoken out, you've had, not just a variance in terms of what they've said, but in terms of just the number that have spoken out in 2017 versus 3 or 4 years ago. This was not a frequent topic of conversation. And so, and I know with even speaking on behalf of, or not on behalf of, but with respect to the SEC, we've since, filed various enforcement actions or trading suspensions related in some way, shape, or form to ICOs since we filed the report. So I think this is still very much a developing area.
I mean, Jeffrey and Kathleen, do you think the ICO space is getting out of control and looking dangerous?
For me, it's an easy one. It looks like a tulip bulb
like a
thing. Yeah. So, being around markets a long time, it seems like a bubble. Yeah.
Look, I think it's definitely frothy, and there's no question that a lot of people are going to lose a lot of money. But from these ICOs, I think. But I think that I think it's a tremendous innovation. It's actually, I think you really have to look at, there's 3 interrelated, innovations. First, kind of Bitcoin and the cryptocurrencies, then the blockchain and the ledger technology, and then in many cases, kind of the cryptocurrencies fed, the underlying technology, and then the ICOs. So I think that you have to look at them as a bit of an ecosystem, and it really creates, democratizes the ability for investors potentially to achieve value there, or to participate in these things at an earlier stage, and for innovators to get support for these ideas. Sort of, an interesting, maybe side note to this. I was sort of out on the West Coast last week, and I think a lot of the VC community is actually feeling very disrupted by the introduction of these, and venture capitalists for many, and I think that many of them do add an enormous amount of value to their companies, but a number of them who've been sort of talking about how great disruption is don't like the fact that they are now getting disrupted by these ICOs, and so some VCs are getting bypassed, but now other VCs are actually kind of part of the coin offering. So I think the system is adapting. I think we're a long way from legal certainty, but a year from now, I don't think that the whole ICO thing will have gone away. I think that it will have kind of stabilized, that there will be greater legal certainty. I think there will be greater convergence among kind of different jurisdictions. And I think there will be greater clarity for innovators and investors who want to participate in those. So I think the innovation's here to stay.
Right. I think we've got time for a couple of questions, quick questions. I think, are there people in the audience with microphones? If not, you'll have to shout. Anybody want to?
I can go to the microphones in the aisles to stand up and, yeah.
Oh, yeah, okay. Apparently there are microphones in the aisles. Any questions that anyone wants to put? There's one microphone over there. Yep, over there. Yeah.
Yeah, just, if you start from the premise that this technology will continue to evolve, and you'll have a greater adaptation of, or adoption of, let's say, robo-advisors, algorithmic trading, it's not inconceivable to think that there might be a larger systemic risk, given that it's a lot of the same people programming a lot of the same robots and a lot of the same algorithms being developed, where there could be a broader implication to the market of basically all of them adhering to the same rules and carrying out the same processes, perhaps triggering market fluctuations or things like that. Just curious of your comments of what can be done from a regulatory perspective, and do you see that risk?
I guess one comment that I make with respect to that is there's a growing effort of coordination and communication among regulators around the world. So there are bodies like the Financial Stability Board and the IOSCO, the International Organization for Securities Commissions, that are looking at issues related to fintech, distributed ledger, and even areas like risk to evaluate it. And the reason I highlight that is because in that regard, you have regulators who have maybe different perspectives, but also seeing different things coming together. And there's been, even in this year alone, a variety of reports, many of which I think have been published from some of these international organizations that are starting to at least examine those types of issues.
Yeah. Yep. So, I think to sort of break that down into some, I think that those certainly are important things to be concerned about, and let me maybe take kind of two subsets of that. So one is kind of interdependencies and interconnectedness, and I was, in addition to working in fintechs, I mentioned I was responsible for supervising kind of clearinghouses, and so some work has been done because there's concern over the interdependencies, because you have the clearinghouses, you have the clearing members, particularly in derivatives where a lot of risk has been concentrated into these, but clearinghouses clear derivatives, equities, all the products that we see, and then it looked at what are the touch points of, well, where are they getting their credit facilities? Where are they getting their liquidity facilities? Where are they storing their cash? Where are they storing their securities? And one of the findings is that there's been a consolidation. There's fewer and fewer places. So if one of them, if one very significant provider fails, the fact that that's going to have ripple effect. So those sorts of interdependency effects are being studied. People are trying to kind of chart and quantify those. I don't think, frankly, that it's necessarily clear, kind of what the antidote that is. I think that the first step for regulators is to try to, identify and measure the problem. So I think that's one concrete thing, to give a specific example of the types of studies that Ryan was alluding to. I think a second area, and this kind of goes to Jillian's question about, what about these rogue algorithms or robots, and the way that one way regulators kind of frame that is looking at what controls do you have over outsourcing? What sort of operational controls do you have? What testing do you have? How frequently do do you do that? And so particularly in kind of the traditional regulatory environment where the regulator has oversight of centralized actors like exchanges, clearinghouses, broker-dealers, you can go and look at those entities and see whether they have controls in place, people in place with the appropriate expertise and systems. If, in fact, with distributed ledger technology and blockchain, we're moving to a more decentralized world, then I think it will be much harder to sort of identify all those points of who has responsibility, who has what systems, do they have the right controls in place?
I mean, I think it's certainly something we need to keep an eye on. I think what we are seeing is perhaps a more complex picture. So we see sort of growth in non-advised business and people actually not taking robo or face-to-face advice or telephone, whatever it may be, actually people making their own decisions. And so it's just as important to look at the tools they're using when they take their own decisions outside of an advised context. We also need to think about what's the counterfactual. So if we think about where people's money is, who is robo advice aimed at? So often it's aimed at people who either will not or cannot pay for traditional face-to-face advice at the moment. So actually, by definition, you're looking at relatively smaller amounts, and that's what we're seeing at the moment, certainly in the UK, is it's relatively simple. It's based on relatively smaller amounts. It doesn't tend to be for the larger portfolios that we're seeing sort of pure robo in terms of the models that are being developed. Obviously, you see tools to help people who've got more money in terms of portfolio selection and so on. But I think it's about looking at part of that. And what's the counterfactual there? Well, actually, most people's pension funds in the UK are going into a default fund in any case of some description. Most people are saving into their accumulation retirement pot and then staying with their same accumulation provider when they come to decumulate. So actually, tools that can help people to move around a bit more at that point might actually spread the risk a bit more as well. So I think it's something we need to keep an eye on, certainly, but I don't think it's a simple solution in terms of actually just saying, yes, it's going to be a systemic risk or not, because it's developing in multiple ways.
Right, thank you. Well, I think sadly, very sadly, sorry?
We have to move on, yeah.
We have to move on?
Yeah.
Okay, I'm very sorry indeed. I'm being told by the Robo Regulators that we are we are sadly out of time. But it's been a fascinating conversation. I think we could have carried on for another hour because these issues are so important and fundamental and fast changing. And I guess the one thing that's crystal clear is that it really is a topic that jumps across different silos, and there's going to have to be a lot more talking and discussion across the silos to find any kind of answers. So good luck to our 3 robo-regulators.
Yeah. Thank you, gentlemen.
And thank you very much indeed.
Thank you, Gillian. Thank you so much.